All right, February 11th. This is the last video on market structure. It's a little long, but we'll get through it. And then we'll talk about the 2 or 3 pair that we got to talk about this week. All right.
Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. I just very quickly wanted to start off this video by saying thank you to over 2,300 of you who attended our yesterday's live session. Hopefully you did have some breakthroughs on that call. As I promised, that was going to be a continuation of the market structure series. So this video indeed is the final piece of the puzzle to market structure, where we bring in supply and demand and also how to get those lower time frame entries. I wanted to also give Vishal or Vigok a huge thank you from all of us for joining us on the call yesterday and breaking down your charts on Euro USD and US 30 and helping everyone with a much better understanding of these concepts. If you guys want to check out Vishal, I'll leave the link to his channel down below. He's got some phenomenal breakdowns on his channel and he's going to be posting more as well. So definitely check him out, give him a subscribe, give his videos a watch, as I'm pretty sure you would have your breakthroughs watching his content as well. Now, the video that you're about to see starts from exactly where I start to share my screen. So we jump straight into it, and I'm going to keep the Q&A perhaps for another video, as a lot of the questions that we answered have either been covered in my previous videos or we have already gone through it in this video. So in another video, I might post the Q&A later on, but I want to do a more detailed Q&A later on for a video to answer a lot of your questions. And the very final thing I'm going to say before moving to the video is please be very careful of fake comments, people trying to impersonate myself or other people saying, hey, go and message this person for Bitcoin investments or this and that. Let me tell you this, I don't have an assistant, so I'm never going to send you to my assistant or my investor or anything like that. The only place I'm going to send you to is my Instagram or my website. My Instagram is Pips of Persia, no underscores, no nothing, and my website is pipsofpersia.com. That's it. These are the only 2 places that you can actually either reach out to myself or check that has actually got anything to do with me. So in no way, shape or form, I'm going to get you to make investments on my behalf or send money to my assistant or, give a WhatsApp number or anything like that. So I just wanted to say that so everyone stays careful of the fake comments. Always double check the channel that's replying to your comment to make sure that it is the main channel or not. And if you come across any of these fake comments, please do go ahead and report them. But without further ado, let's go ahead and jump straight into the recording from yesterday's video, Market Structure Part 3, mixed with supply and demand and Wyckoff cycles. Okay, let's go ahead and jump straight into it. Now, as a very quick reminder, as a very quick kind of refresher in terms of what we were speaking about before, we were in a way speaking about, let's say, a normal trend going up like this, where you have your low, high, higher, low, higher, high. And, within this trend, we would in a way be able to go ahead and identify all of these high points as the reversal back down as these areas of minus supply. So naturally, whenever the market reverses, whenever the market does a U-turn and goes back up or a U-turn and comes back down, there must have been elements of supply or demand introduced within that currency pair, within that chart, right? So whenever within this trend going up, even within these little pullbacks, the market is coming back down, these are now your areas of supply or minus supply within the range. And as you can imagine, every single one of the lows that we work with, this would be an area of demand, an area of demand, an area of demand, right? This is very basic, very straightforward. And, even if I go ahead and change it the other way, all the blue zones are now your areas of supply and all the red zones are now your areas of demand within a kind of bearish trend, right? Very simple and very straightforward. You should all know this in terms of supply and demand. I'm not going to spend any more time on this. Whenever the market reverses, there must be elements of supply and demand. Looking at this from a Wyckofian standpoint, however, if I want to start to draw it a little bit more accurately and a little bit easier, this is how I'm going to start to kind of draw it. And I'm going to keep looking this way just to kind of, look at my notes and make sure I'm not waffling, let me be real. So within a trend going up, this is how we can kind of start to draw it. Let's say you start your accumulation phase, the market goes up, gives you that little distribution, it comes back down, gives you another accumulation, it goes back up, gives you another distribution, comes back down, gives you another accumulation, and so on and so forth. It's the same trend that I just drew from low, high, higher, low, higher, high, higher, low, higher, high, but now in terms of Wyckoff supply or Wyckoff accumulation or distribution, which is actually the same as supply and demand. What I mean by that is this distribution that took place up here is the same area of supply that we were talking about. So is this one. These are now areas of distribution at the top of the range where the market is giving you that little retracement back down. Those are areas of supply. And by the way, let me go through everything and then it will make sense. So if right now you're still kind of trying to grasp it, why does this matter? Why is this relevant to the trends? It will make sense. Believe me, there's a reason I've got so many tabs open up there. We'll go through it, right? And all of these areas of accumulation down here, these are now your areas of demand. From a Wyckoffean standpoint, a normal trend can look like this: accumulation to distribution to accumulation to distribution. But here's the thing, the trends are never this clean. Let's be honest. They are never this clean. So how does a real trend oftentimes look? A real trend, a lot of the times, can start to look like this. You get your accumulation down here, and the market, let's say, goes up and starts that distribution phase. It comes back down, maybe it gives you a little minor accumulation. It goes up, it reaccumulates before taking that distribution. Then it goes higher, give you a little minor distribution up here. Maybe it comes back down, gives you another accumulation range and another reaccumulation range over here before going higher. What I'm trying to help you understand is within the same range, you would have areas of distribution. Let me actually start with accumulation as blue. So areas of accumulation, areas of distribution at the top of the range, and the same way that the trend needs to continue, so do these accumulations and distributions. And what I mean by that is you would be able to spot areas of reaccumulation as the market is also going up as well, and vice versa. It goes without saying, when the trend is coming the other way, you would be able to identify areas of distribution as well. So for example, as this market coming back down, you get these lower time frames redistributions within the range as well, as the market is kind of coming lower and lower and lower and lower and lower. Now, okay, so we now look at the same trend from the perspective of normal trend, supply and demand, and then we looked at it from the perspective of Wyckoff accumulation and distribution. And now you can kind of see this trend from the perspective of a reaccumulation and a redistribution. Now, this is where I want to kind of elaborate a little bit more on drop-based drops, rally-based rallies, and I want to kind of speak a little bit about the similarities of this to, quote unquote, institutional concepts, and how practically anything that you've been looking at the chart so far is the same as what the institutional traders do in a way, but just from a slightly different angle. And how I'm going to actually go ahead and describe this is like this. A lot of you have actually traded using rally-based rally or drop-based drop formations. If you don't know what that is, normally that's when the market gives you a little, let's say, move to the downside, significant drop to the downside. It goes sideways for a matter of a few candles, maybe a few dojis, one doji forming in the middle, a little wick, consolidation region that takes place before this market has the next move to the downside. This is what you call a drop, base, and a drop, and vice versa. You have the rally where the market rallies, goes into that base region, one or two or three small candles, an area where the market hasn't really moved, and the continuation rally away from that level as well. Now, one thing that I need everyone to understand, especially if you're trading supply and demand, is this drop-based drop formation is another version of a redistribution. This rally-based rally formation is another version of a reaccumulation. Not only that, the drop-based drop formation is the same as an institutional candle in the middle of the range. It's the same as those lower time frame or redistribution, obviously, that we spoke about. It's the same, it's actually quite similar to break and retest as well. Let me put it that way. To an extent, for those of you who are trading supply and demand using rally-based rally and drop-based drops, you'd kind of agree with me when I say this is just a little bit more advanced version of break and retest. We just know more or less exactly which break and retests are going to happen and the ones that don't, right? So this is the very, very first thing that I need everyone to understand. That drop-based drops, rally-based rallies, I'm going to actually start to write them here. Many, 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 many different names for the same concept, right? So for example, you have a drop-based drop, a DBD. A drop-based drop is the same as a redistribution, right? It's the same as when the market is redistributing going lower. I just hit myself in the nose, but it's when the market is redistributing and going lower, right? It's the same as that institutional candle in the middle of the range. That's the base area that you identify. All of these are the same thing: supply, demand. Obviously, I have to kind of add let's say rally-based rally over here as well, and the reaccumulation as well, and so on and so forth. What I'm trying to help you understand is these are all the same thing. They're just looked at from slightly different angles. And in today's angle, I want to break down supply and demand to the best of my abilities. And Bish, I was going to go into a lot of detail about indices as well. I'm not going to share anything about that yet. But we want to help you understand that these things look different on the charts, but they're all the same concepts. And how can they look different? Sometimes you would get something like this. You would get one candle pushing down, So you would have, for example, one bearish candle pushing down, and then in the middle, you would have this bullish candle pushing right back up, something like this, right? So bearish candle pushing down, bullish candle, and a continuation of that. You've seen these scenarios left, right, and center everywhere. That's your institutional range. That's your range in the market where you can in a way see the drop, base, drop, your institutional candles, punch candles, whatever you want to call it. I don't care what name you put on it. It's the same concept. That's where on the lower time frames, the market has redistributed and gone lower, which means at that level, there was new supply introduced to the market. I'm going to repeat that one more time. Pay very close attention. At that level, there was new supply introduced in the market. Write that down, put a little pause on it. We're going to circle back to that later. What do we mean by new supply and why does that even matter? By the way, on some other time frames, this can actually look kind of different. You can even, for example, have, let's say, a bearish candle pushing down and let's say another bearish candle straight after that. So without any base in the middle. Sometimes it looks something like this, right? So two bearish candles, yet you would in a way be able to actually see the wick, something like this, right? It kind of would look like that. So instead of it being an actual base in the middle, it's just two candles, one of it wicked down, another one wicked up. But as you can imagine, for this to be created, the markets must have come down, gone back up, and come back down. It's the same thing. It's the identical scenario that's being printed. That's your base. That's your drop base, drop formation. That's your newfound area of supply that's being introduced to the market. That's your lower time frame redistribution. I can put it the other way as well, and everything is going to be switched, right, to a rally-based rally and a reaccumulation. But it's just the same picture. That's the first thing that I kind of need you to understand. And not only that, by the way, we've got kind of drop-based rallies, rally-based drops, these type of things as well, where drop-based rally, rally-based drop. In these type of scenarios, that would be your accumulation down here. This would be your distribution up there. It's all kind of the same concept, the same thing, right? Now, when we spoke earlier about a new supply and why that supply is important, this is where I'm going to kind of start to speak a little bit more about entries and how we actually go ahead and take entries using supply and demand and using drop-based drops and rally-based rallies. Okay, now let's go ahead and get rid of this. Right. A lot of people ask, Mehdi, what steps do you take to actually analyze the charts? This is what I do. I look at my trend. I look at my supply and demand. Then I want to look at my proof / validity. Then I want to look at my entries. Very simple, very, very, very straightforward. And what I mean by that is this. I look at my trend. So if in the trend we've got this bullish move, excellent. I'm looking at an uptrend. Easy stuff, phenomenal. Then I want to go ahead and look at those areas of supply and demand. And what I mean by that is the same areas that we started to highlight. Those are now areas of supply. These are now areas of demand. But naturally, if I'm looking at a bullish trend and if I know I want to buy it, more so I'm going to care about the areas of demand, not the areas of supply, right? So I want to find which are the key areas of demand or supply. How do we identify what is the key area of supply and demand? And what I mean by that is how do we go ahead and answer the question as to which institutional candle do we take the trade based on? How do we figure out what is a key area of supply and demand? Looking at this trend, parallel to what we were speaking about earlier in terms of Wyckoff accumulation and distribution and reaccumulation and redistribution, as this trend is forming, chances are we had a minor distribution phase up here, right? So this in itself is actually going to act as a future area of supply. Pay very close attention. This over here in itself is going to act as a future area of supply, which means if supply was introduced once, there's a chance it can be introduced again for this to come lower. Now, if that doesn't happen, it begs the question, why? Why did that not take place? If the market didn't reject this supply and go back down, you should start to now ask yourself the question, number one, why it didn't get rejected? And number two, what was the cause that, in a way, invalidated that level, right? And what I mean by that is this. If the market is meant to start to reject this and go lower, on the lower time frames, you should start to be able to identify your distribution scenario up there, right? It's as clear as day. If we've had supply top of the range, the market has reversed and all of these things. And as we approach that again, we start to form that distribution, then obviously it's a lot more likely for this to go lower. But sometimes that doesn't happen. Sometimes the market creates very clean reaccumulations as it approaches these areas of demand or these areas of supply or demand, depending on which way you want to break it. And this is where the reaccumulation comes into place. Do you remember we spoke about accumulation leading to a distribution, leading to another accumulation? A lot of the times you would be able to spot areas of reaccumulation right before the market invalidates a specific area of supply and demand. What I mean by that is this: if this was our previous area of supply, the question is what actually started to invalidate it. In a way, if we approach that level and start to distribute, that means we're introducing supply again. But if we approach that level and we are reaccumulating, what does that tell you? If it's approaching that level and it's reaccumulating, this should scream in your face that there's new demand being introduced. There is a higher probability of this market going higher, breaking above that high, than it is actually rejecting it and dropping lower. And surprise, surprise, those reaccumulations on the higher time frames, they look like base rally formations, where you have the rally, you have the base in the middle, and you have the continuation of that. Now that becomes your newfound area of demand. As simple as that. That's how I look at my supply and demand. So in a way, let's say I'm analyzing this chart. Let me go ahead and take these off. So let's say this is the trend that I can identify, and I want to go ahead and analyze this chart. And I kind of know, obviously, this is, for example, where we are in the trend, where we are in the market. And I can see that we've had a distribution phase up there. And this distribution phase has now led to another accumulation that has, in a way, broken that structure, or a reaccumulation that has broken that structure to the upside. Either way, that area of supply was not substantial. Therefore, it got broken to the upside, right? And I want to kind of ask myself the question as to why. And what is now my new area of demand? Because if the supply was invalidated, that means demand must have been introduced. If the supply was invalidated right over there, that means demand must have been introduced to invalidate that level. Otherwise, it's supply level. You expect it to drop from there, as simple as that. So now I want to start to look at what areas of demand started to invalidate that supply. Very simple and very straightforward. You can find your institutional candles, your area of inefficiency or imbalance. You can start to look at your reaccumulations on the lower time frames, whatever it may be. And once I managed to put my finger on those, once I managed to identify the areas that were in a way sponsoring a specific move, I would want to wait for something called proof of validity, right? This is not really called proof of validity. I'm just kind of waiting for a proof, really. So if I've identified a newfound area of demand, and I'm going to show examples, by the way, for all of these. So if I've identified a newfound area of demand, which has now invalidated the previous supply, this demand, here's the way I want you to look at it. That rally-based rally, that reaccumulation or institutional candle was in a way there to sponsor a break of supply, to sponsor a break of that structure to the upside. So in itself, it has to still prove to me that it holds the weight of a demand, because that demand could have just been introduced by the institutions to get rid of the previous supply, not necessarily for it to hold for future trends. It might not. So what I want to do is I want to wait for some type of a proof of validity. And oftentimes this happens on the lower time frames. Where as you get these pullbacks back into these levels, your proof of validity is a break of a minor structure point to the upside. Now that area of demand is deemed as valid. And here, and this is the important thing, right? A lot of you have seen this and now you're confused thinking, yeah, but I've seen that it comes up here, it still reverses and goes back down, even though it's given me that minor break of structure to the upside. I want you to start to look at the key areas of demand or supply. So within this trend coming back down, more than necessarily the exact structure points, we want to look at the important structure points, the ones that you can see that supply was introduced and it has gone ahead and created a new structure point in the market. It's very simple and very straightforward, right? That's the validity of your structure. So that break of that structure to the upside is now going to prove to me that whatever supply we had previously is now invalidated. Chances are we're going to get a retracement and go higher. Trade management comes into this a lot as well, because now you're taking a higher time frame trade based on lower time frame break of structure. So you've got to manage your trades properly as well. I'll speak about that. But again, reiterating on what I spoke about, this in itself wouldn't necessarily be my entries unless I have enough confirmations. I don't necessarily go ahead and enter it there all the time. A lot of the times that would be my proof that, listen, the previous demand that was introduced is still valid. That's your proof. That's your break of the relative structure point to the upside. And it goes without saying, these retracements would be our entries to take this higher. And these retracements, they will line up with the significant areas of supply and demand. What do I mean when I say significant areas of supply and demand? If this market started to create a reaccumulation, as it broke that structure to the upside, chances are it's going to go ahead and react off of that reaccumulation. I'll show you based on the examples. But before we get into the chart breakdown, what's the time? 5:36, yeah. Before we get into the kind of chart breakdowns exactly, I want to elaborate a little bit further on how you would manage the trade here, how you would manage your risk over here, so you can kind of know that a big part of this industry, a big part of trading and investing is managing your investments. Making money is not the most difficult aspect of this business, right? It's really not. It's retaining the capital that's the most difficult. Making money is something that practically anyone can do. I'm going to be real with you. But how many times have you grown an account and then within a few days you've blown it straight away? It's disappeared. It's about retaining the capital. And for you to retain it, you need to get good at managing your trades and managing your risk. A lot of people within these scenarios, they get extremely lost because they want to identify the best risk to reward. They would want to enter it there and then and have a 2-pip stop loss because they've seen that that's possible and they would want to take it to the upside. And you would see that your direction is spot on. So every single time you can identify direction correctly, but also every single time you're getting stopped out before the market moves in your desired direction. I'm going to give you a very simple solution to that. Pay very, very close attention to what I'm about to say. If I know that I want to go ahead and buy this at that level over there, right? Let me change this blue. If I know that I want to go ahead and buy this at that level, because that's my institutional candle or whatever it may be, I would have one entry that's going to be the biggest stop loss trade, whatever that entry and stop loss is going to be, right? One entry with the biggest stop loss, right? So which means one of my entries is going to be the largest stop and the most minimal possible risk to reward, right? And then I would divide my risk accordingly for the better positions. And here's the example that I would make. Let's say over here, you have an institutional candle in the middle of the range, and you want to go ahead and take your trades based on that. One of your entries could be at the institutional candle with stop losses below that major structure point, and another one of the riskier entries could be the same entries, but your stop losses, for example, at the low of that candle or a little bit below that. And what you're doing in this case is you're dividing your risk into 2 positions with 2 different stop losses, but the same entries. Sometimes it could be 2 different entries, but the same stop losses, 2 different entries and 2 different stop losses. The point is I'm dividing my risk in 2 or 3 positions. So if you normally execute a 1.0, in these 2 scenarios, you're going to do a 0.5 and a 0.5. So the total risk on the account stays the same. Well, obviously, calculate your risks accordingly based on the stop losses that you see over here. So half of your risk and half of your normal risk. The risk on the account stays the same. But what this will stop you from is that element of greed. How many times have you had the major trade play out and you miss out on a 1 to 5 or a 1 to 10 because you were waiting on that 1 to 8? In this scenario, you're going to catch that 1 to 10. So that fear of missing out instantly is going to disappear. You're still going to be in that trade. You're still going to increase your capital, and have that return on investment. And the risk on the account is also going to be the same. So if you're wrong on your trades, you're not going to lose any more money than you're willing to lose, if that makes sense. Your risk stays consistent. And if both of them play out, then hallelujah, right? Phenomenal. You're going to make your money. Amazing. So start to manage your trades properly and start to manage your risk properly. That's point number 1 that I wanted to mention, that if you look at a chart and you feel like, I don't know where I want to have my entry and stop loss, assume the biggest stop loss and assume the smallest risk to reward. If you're happy with the stop loss and the risk to reward, execute the trade, and then look for refinements. Another thing that I'm going to add to this is areas of target. In this specific scenario, you have to remember where you would want to be targeting, right? Because in this specific scenario, as the market is in a way reversing and going back up, you're taking the trade based on the lower time frame break of structure to the upside. So now, let's say if the bigger trend is on the, let's say, for example, H1, but the lower time frame trend coming back down over here, let's say that's, for example, on the 10-minute time frame, right? If these are the stuff that you're able to now identify, you have to now see that you're taking the trade based on a break above the 10 minutes minor structure coming back down, which means you're taking the trade based on a 10-minute breaker structure. The higher time frames could still be respecting the bearish trend that's kind of forming, right? It's a higher probability that it breaks that structure and it's going to go higher, but you have to manage your trades accordingly. And what I mean by that is because you're trading it based on a 10-minute breakup structure, your first set of targets would have to be based on the 10-minute time frame. So in this specific scenario, you would have to start to take positions off the table as this market reaches that high, as this market starts to get to the major areas of supply and demand on that specific time frame. Now I'm good with the notes. Okay, so let's start to actually have a look at the charts and have a look at examples for this and exactly how we can, how we have seen the charts move and how you can start to look at the charts from this perspective from today onwards. I'm going to go through a few different examples over here. I'm going to cover a few different things. So we're going to go through Euro JPY. We're also going to cover GBP USD. Obviously, we're going to cover GBP USD and we're going to cover AUD JPY as well. Now, truth be told, I wasn't actually going to go through chart breakdowns myself. I was going to leave that completely to Vishal. But as I was kind of going through some of the past trades and documentations, I came across a few of them that actually applied perfect to this training. So it would have been rude of me to not cover it. Let me put it that way. So let's start off with Euro JPY, right? This is kind of like obviously a very basic one, a very straightforward one, where on the higher time frames you could kind of see those elements of manipulations to the downside. We've taken these lows on the higher time frames. This market has now reversed and has broken above these significant structure points. Over there it hadn't yet, but over there it did. So naturally, the original kind of bias on Euro JPY was bullish. We should kind of be expecting some type of a bullish move. And this is where kind of this first picture comes into place. And this is documentation from some time ago. So we're talking January 12th this year. So around March, April, 3 months ago exactly, more or less. So and this is the first picture where this was kind of generally what was identified. The 8-hour time frame is what we're looking at right now. Weekly manipulations of the lows, daily upside and breakup structure, bullish. That's exactly what we spoke about. The manipulation of the lows over here, that breakup structure to the upside that was taking place right over here, right? That break of that structure point to the upside. Now the market is starting to shift in that higher time frame momentum. And looking at the specific picture that we were analyzing, we can identify this even final trend. So check this out. You can see your major points, your major trend. You can see your little minor trends coming back down over here, right? And then you can obviously see the break of that minor structure point to the upside as well. So far so good. We've gotten exactly kind of where everything that we wanted to get, really. And now check this out. This in itself over here should have proved as an area of supply. Not only that, this entire area up here, this entire level, this is our round off, right? So we have supply over here and we have supply right over there as well. The point is the second circle, the second area of supply is a very substantial supply. This market took time and it did distribute. It was within this distribution phase over there, more or less, right? Kind of turn into a reaccumulation later on. But that is a very strong area of supply over there. So as this now is starting to break lower, as this now is starting to challenge these minor structure points to the downside, the question is, what sponsored that? What took this lower? There's a lot of levels in the middle. I'm going to shift my focus to this institutional candle on the top of that range. It was more or less that candle that was the final push to the upside. And you can see the market completely collapsed before then. And you know why I see that candle as a strong one? Because this market was finding it difficult to break above it. Can you see? It was finding it difficult to approach these levels and start to break above it. It kept approaching it, getting closer and closer to it, even manipulating the highs or creating equal highs, but it most definitely didn't want to break it up until this candle, up until what we started to form over here. An extremely substantial candle over there. The 8-hour institutional candle, such a strong move to the downside over there and a reversal straight after that. This area is now your newfound area of demand over here. Why? Because this is where we introduced demand. This is where the market makers, or let's say the institutions, were reaccumulating on the lower time frames or pushing the market down to give themselves a better entry points for these buys to the upside. And it was this area of demand that has now gone ahead and crossed above the previous areas of supply. So that area of demand down there, this 8-hour institutional candle, is our newfound area of demand. That is the demand that pushed the market higher than where it was struggling to go above. That's the demand that pushed the market higher than this entire redistribution phase and these institutional areas in the middle. That was the demand that in a way sponsored that move to the upside. So I've got the demand. Now I want to see if the demand is still valid. So what you see over here is what I have written over there. 8-hour bullish. We've got our institutional candle as a point of interest. Remember, it doesn't have to come down there. Pay attention to price action. That's what I've written over there, because not always it will come down there. Sometimes it can reaccumulate and then go higher. For example, when you look at this specific level, when you look at just this picture, there is another level at the top as well, which is kind of quite attractive for entry. Let me see if I can. I don't think I can annotate on the same screen. So let's come back here. Looking at this reaccumulation, if I put this in replay mode, or potential reaccumulation, right? Looking at this structure that's forming over there, this area in itself would actually be an attractive area for buys to the upside. This area would be an attractive area because at the end of the day, you can see your lower time frame trends. You can see this was your final accumulation pushing higher. So I now want to wait for what we call that proof, the validity. If I want to buy it from here, I still kind of need to see my validity. I want to see that that demand is valid. If I want to buy it from down here, I still want to see that that demand is valid as well. In this specific picture, we started to actually form these drop-base drops as the market started to approach these first areas of demand. Can you see how new redistribution was introduced to potentially invalidate that previous accumulation? Looking at this on the 8-hour time frames, or let's say 12 hours, probably going to be the nice one over here. Yeah, these are your candles in the middle of the range. And even looking at this structure over here, you can see that we've taken the highs. It's manipulated the highs. That wick over here, that's taken the highs and it's ready to go lower. Studying this on the lower time frames, I'll leave this up to you guys to do this for yourself. That in itself is now your area of redistribution. If you want to know the date and time for it, roughly we're talking 12th of January this year at around, let's say 8 p.m. UK time, right? So let's say towards the end of the day. That area is an entire redistribution area. I want to encourage you to go ahead and mark that up and study that for yourself. We've got enough redistribution videos on my YouTube channel as well. But when I start to see things like this, when I start to see on the lower time frames, especially that we are taking the highs, this is taking the highs, it's manipulating the highs and reversing. It's giving me these pushes to the upside, distributing, taking the highs and reversing and maintaining the price below as well, not end up going higher. These are now in a way your guidance in a way that this is probably not going to reverse up there. So I had that 8-hour point of interest in mind and I thought to myself, you know what, that's a strong area. We kind of need to see proof at that level. So once we approach this level, I want to see the lower time frame break of structure to the upside. I'm going to repeat that one more time. When we approach that level, I want to see those lower time frame breaks of structure to the upside. So I've got my 8-hour marked up, and that was again the picture January 12th that was taken. So we've got that point of interest marked up, and now we've gone ahead and have approached that level over here. This second picture is January 20th, so it's just over a week after the first picture was taken, and this is throughout London session over there. So this was in a way where the market started to approach that desired level and started to create the accumulation schematics on the lower time frames. Now, I'm very honest with my markups. I was hoping for a more defined accumulation. I was hoping for this accumulation to look a little bit better and a little bit easier to read. But in reality, it wasn't as easy as I wanted it to be to spot it. And it was something that we would be able to see happen once the market moved away. So check this out. This whole red area down here is that 8-hour point of interest. On the 8-hour time frame, on the lower time frames, you can see the market is trending as it's approaching our POIs. Let me just delete these things that we don't need. The market is trending as it's approaching these points of interest. It's coming lower and lower and lower. And over here, when it accumulated and it took off so impulsively and so aggressively, this is now your bullish confirmation. This is now in a way where the market is telling you, hey, I'm probably going to reverse from this level. So when you look at this picture, this is taken on the same time frame, on the 15 minutes. There is one area that I've highlighted right over there, because this, to me, in my eyes, that was where we introduced the final supply, right where my mouse is, the final supply for this to go ahead and take the lows, go ahead and create that spring to the downside. So a break above that level is going to be a significant one. A break above this level is going to be the significant one. So if I am to take these trades, I have to wait for these lower time frames to break structure before I do it. And when you look at this market rallied away from our level. This is now your proof of demand. This is now where the market is saying, hey, that demand is valid. The order flow is valid. We are going to go higher. When I start to see these moves away from these levels, it gives me that confidence. And surprise, surprise, what did that look like on the lower time frames? Let's go back. Remember the area that I just highlighted? So I said a break above where? Right over here. Break above there. What did we do right before it started to break above there? That entire blue region that I've highlighted, that's your reaccumulation range. That's where the market in a way created a rally-based rally and started to break above those levels. So when you look at that picture on the higher time frames, surprise, surprise, you would be able to see, well, probably on the hourly a little bit easier, you can even see on the 4 hour your base, and on the hourly time frame, much cleaner in terms of your rally-based rally. Now, it's a little bit too many bases in the middle. It depends how you want to trade it for yourself. But on the 1 hour, 2 hour, 4 hour time frames, you can clearly see how it's created the low, reversed back up, started the reaccumulation range, and it took off. It was this reaccumulation that sponsored the entire move to the upside. The market went sideways and it took off. Is it a surprise to see it back down at these levels? Of course not. Of course, that shouldn't be a surprise. And those should be the areas that we would want to look at for our entries. Because now we've seen the demand on the 8 hour institutional candle. We've seen this validity proof. Therefore, we can start to look at our entries up from there. Very simple and very straightforward. These are the steps that you can take. Now, this is Euro JPY. So right over there was hoping for a more defined accumulation, and then right back within. So this was literally where it literally came right back down to these areas of reaccumulation right over there, and it took off. Now, let me go ahead and move on to a couple more. I want to make sure I'm not talking too much so Vishal has enough time to kind of go through his stuff as well. So briefly and quickly, I want to go through GU and AJ, and then this coupled by what Vishal is going to go through, hopefully should result in many breakthroughs. So GBP USD. As a lot of you know, I'm still in sell positions for GBP USD from more or less the top of the range from that, not that high actually, no, yeah. These are the sell positions that I'm actually still actively within for GBP USD right now. Both of them are still open. A lot of you have seen multiple screenshots of this on my story. I've been documenting these quite well. And the last YouTube video, the second to last one, is actually about kind of the first scenario breakdown as well. So everything is over there for you guys to check it out for yourself if you want. But generally speaking, with GBP USD, let's start off on the higher time frame. So, for example, daily or weekly. I want to actually start off on the weekly time frame. So the weekly time frame was this manipulation of the lows and blah, blah, blah. The market went up, you know, all of these things. I'm not going to speak about it too much more. But check this out. If you were looking at this on the weekly time frame when it was happening, you probably would have actually been looking at sell positions rather than buy positions. I'll be real with you. Why is it taking so long? Yeah, trading view. Let me change time frames and see if it, there you go. So if you were looking at this on the weekly time frame at that time, it probably would have actually looked pretty attractive and pretty good for those sell positions. Right? It's struggling to load the weekly time frame on replay, but there it is. So that's in a way your buy before sell candle, your institutional candle on the top of the range that has sponsored this move all the way to the downside. And maybe you were looking at some sell positions over here. But again, pay very close attention. As this market started to reapproach that level, so first things first, the first time we rejected it, it respected the lower time frame trend. It didn't break the trend. The first time we rejected it, it was actually still trending. The second time that it started to approach it, it was sponsored by this rally-based rally. It literally created an area of reaccumulation on the lower time frames, approaching the previous supply. So it shouldn't be a surprise to see this market break above that supply. It shouldn't be a surprise to see this rally-based rally, this area of reaccumulation, sponsor the break higher. And it also shouldn't be a surprise to see the rejections back down to these levels, to see the market want to be pulled back to these rally-based rallies or drop-based drops that are sponsoring a specific break and then moving in that given direction. So that's the first kind of picture I wanted you to see as an example on the weekly time frame. The other, in a way, the other side that I wanted to explain would be the daily time frame from that very high. So at the end of the day, over here, we've had supply as well, and the supply has resulted in such a strong move back down At that area of supply up there, we can expect the market to reverse. And naturally, you've got two areas of significance. You've got this one as your drop-based drop formation. And can you see this is an example of literally what we spoke about earlier? This is still a drop-based drop formation. This is still an area of supply. The market has dropped, has gone back up, and has dropped again. That's the same. I've just identified the wicks, right? Literally the opposite of an imbalance is what I've identified over here. So we've got these two specific areas in mind because it seems to me, number one, it was this area as the high point of supply that sponsored the break below here. And it was this reaccumulation that sponsored the break below there. Or this one, or for example, this redistribution, sorry, not reaccumulation. So either way, those are areas of significance that later on we can see reversals from. But the first area, something interesting happened as the market was approaching that level. Surprise, surprise. It's yet another rally-based rally. You can literally see that on multiple different timeframes. You can see two rally-based rallies. Mostly, I want to speak about this first one over here. This one. The market rallied, created the base, manipulated the lows. You see, it's taken the lows over there within this rally-based rally. Within that entire range, it's gone ahead, created lows and taken the lows and reversed. That's what that looks like on the lower time frames. That's an area of reaccumulation as it's approaching your supply. If it's reaccumulating, approaching your supply, it's not going to reverse at that level, I promise you. So unless it starts to distribute after that. But now when I start to see things like that approaching that level, it pushes my eyes towards the higher level. And if we are getting those reversals from those higher levels, then obviously I can get into some lower time frame counter trend trades coming back down. Let me not elaborate on that too much right now. I don't want to get into counter trend trading. That'll be a whole other conversation, a whole other training. But very quickly and briefly for GU, this was kind of the buy scenario that was identified. So obviously we got in the sell positions from these high points. I'm not going to even touch on these. There's full breakdowns available for you guys to see. But these sell positions, I wanted to, in a way, eventually look at certain buy positions. And this was one of the first pictures that I started to actually look at on the minute time frame for GBP USD. It wasn't, the entire analysis wasn't based on the minute time frame, but we did start on the lower time frames for those buy scenarios. And this was this range in the market over here. When I started to look at this specific range, it was quite interesting to see what took place exactly over here. There was a reason why I thought to myself, this could be the bottom of that range, the bottom of the market, simply because it was happily trending lower. It was happily introducing supply and going lower. Then all of a sudden it went, nope, and it went all the way back up, invalidated some, minor areas of supply, but it was liking it. It was kind of spending time on the other side of the zone. So it wasn't just the manipulation of the highs for this to kind of reverse and come all the way back down. There was something more to it. So I thought to myself, you know what? This area down here, the highlighted area, is a potential area of demand. And the highlighted area is this one right over here. Give or take this region I highlighted. And the reason why I highlighted this specific region is because that would have been the manipulation of the lows, and that would have been this final area over here that sponsored that move to the upside. And I thought to myself, you know what? This is where we're going to get reversals. I thought to myself, the market is going to give us the reversal at that exact level. Funnily enough, it went below. And I want to also help you to not get caught out on these trades because we did it. That should not have been your entries over there. This is your proof of demand, or this is your validity. The market's showing that, hey, we have had demand over here, but over here, it didn't necessarily reverse exactly at that level. These wouldn't have been the trades that we would have taken anyway. These trades are invalidated. Well, not valid in my opinion. Heavy counter trend scenarios. You have to wait for the proof and then trade accordingly. So it didn't really matter to me that we reached below that previous area of demand because it still reversed and it gave me the proof. It was just telling me that, hey, we just wanted to take the other low as well. We just wanted to also grab whatever liquidity was resting below there. So it's still okay. The demand is still valid. And when I see that reversal to the upside over there, it gives me the confidence now on the lower time frames, for example, we can look at this. It gives me the confidence that, okay, this is now valid demand. The market has gone ahead and invalidated many of these specific areas. And this would be kind of before and after type of screenshot. So I simply waited for that break above, waited for that proof in a way. That was our proof to the upside. We had our proof, we had our, confirmations. And then if I'm not going to, let me not go into too much detail about this exact scenario. It's a 5-second entry, if I want to be real with you. So it was actually executed based on the 5-second time frame. Take a screenshot of this for yourself, please, to have that so you can see the dates and time on the top over there, and you can see the pair, you can see the time frame, you can see the entry and the stop loss, and you can also see the time right before this trade would have been executed. So this would have been the buy scenarios to kind of take to the upside from here. I don't want to elaborate on this too much because I also want to encourage you guys to start to study this for yourself. You have got enough information now to start to look at these a little bit more independently. So anyway, now that you know everything from here, coupled with this screenshot, you should be able to see exactly what I'm talking about. So we've had that, we've had the proof of demand, we've had the move to the upside, and boom, that's your entry right over there and your stop loss right over here. I'm going to leave it for a few more seconds if you want to screenshot this. And then I want to go ahead and speak about the final scenario before I go ahead and pass it to Vishal, which is our AUD-JPY. Again, a very old scenario. We're talking about December 21st, something that was documented actually end of last year. But again, something so beautiful that I couldn't really ignore. I wanted to include in this trade and in this analysis. Within the screenshot that you're seeing right now, again, it's very similar to what we looked at for Euro-JPY. We have got the bullish trend. We've got these reaccumulations. This is a markup for the reaccumulation. And you can see that the market is kind of going higher and higher and higher. So moving to AUD-JPY. And let me start on a little bit higher time frames. This is where we are talking about down here. So this was in a way a very kind of clean and clear scenario for AUD-JPY. To me, it looked like it was going through this reaccumulation scenario. We introduced demand down here. That was where the market in a way reversed, came back down, introduced demand, and went to create a new structure point, right? So when I see these pullbacks back into these levels, and not only that, we have lower time frame accumulations at these levels, it's now proving that demand to me. So now the market has rallied away, has broken the relative structure points to the upside, and started to create reaccumulations as it's traveling higher and higher and higher. So this over here is this picture, basically. And again, December 21st was when this was actually taken. Now, when you look at this picture, there's practically only one POI that you would look at, which is exactly where it's highlighted, that 30-minute institutional candle in the middle of the range. So I want to go ahead and move this to 30-minute time frame to show you why at the time of looking at the charts, there probably wouldn't have been any other areas of interest to look at, simply because that over here, this was your reaccumulation phase. The market left the reaccumulation, but it did pull back and it created this final institutional candle, and off it goes. So in a way, that's the final potential place that this can pull back to. And this entire thing, by the way, this entire range, what is this? This is your, actually, just keep the blue one. This is your higher time frame, rally, base, rally. This right over there. Can you see it now? Let's go to daily. Might be able to see it a little bit easier on daily and weekly time frames. Right over there. You can see the markups, the shakeouts, AR, BC, all of these things. So that's now a rally, base rally that has gone ahead and has created the new structure point. So obviously we can kind of expect the market to be reversing at these levels. So going back to this now on the lower time frames, that was what I was waiting to see. I was waiting to see if that institutional area is still valid on the 30-minute time frame. Okay. So when we get this rejection up from here, I am actually just waiting for a minor break of structure to the upside. And this is where it brings me to the final screenshot right over there. Literally followed from there. December 21st at 2:15 p.m. December 21st at, again, 2:15 p.m. as well. Literally 2 minutes after I took this screenshot, I took this one to show again. Now I'm waiting for that final minor break of structure to the upside, that 5-minute break of structure to the upside. So let me go ahead and do this. 30-minute institutional area that we were looking at, and this is now a final 5-minute breaker structure, basically. So check this out. This area that we identified over here on the 30-minute time frame, I'm going to show that to you one more time. This area down here as an institutional candle that we identified on the 30-minute time frame, as we were approaching that on the 5-minute time frame, what was it doing? It was introducing supply, and the final supply that was introduced, the final round off that in a way pushed the market lower, took whatever liquidity needed to be taken, and in a way that was our final major area of supply or major area of structure. So I have to now kind of wait for a break above there, and that 5-minute break of structure to the upside is kind of confirming our trades. It's confirming that this market is more likely to go to the upside, more likely to start to actually reverse and go higher and higher and higher. And if if that's my breaker structure to the upside, looking at what sponsored that, you will always be able to find these rally base areas and rallies that sponsor these breaks of structure. These rally-based rallies turn into future points of interest for entries. And that indeed would be able to be the type of trades that you would take, really. The rally-based rally that invalidated that area of supply on the lower time frames, and now I'm simply basing my trades on that. And let me just take this off reframe to kind of make it easier. And this is the kind of final push to the upside from these levels, from that 30-minute time frame that was kind of identified. And you can see around the targets as well. I'm not going to draw my arrow from here all the way up there, right? How do I know the market is going to go all the way up there unless I'm looking at the weekly or monthly or whatever? Normally, it's about how you manage your trades. So I want to be taking the profits relative to the structure, but not all of it. I would keep positions running indefinitely. I'm still in GBP JPY buys from end of January. There's still so many scenarios that we're in from a long time ago. So with that being said, now we've kind of gone through a little step-by-step kind of guide as to what to look at. We've spoken about structure from a supply and demand perspective, rally-based rallies and drop-based drops. And not only that, we've also given 3 examples as to how you can look at your trend, look at your supply and demand, also look at your significant areas of supply and demand that are invalidating the previous ones and basing your trades on that. Trend, supply and demand, proof/validity, and then from there you look at entries. Now Vishal is going to kind of speak a little bit more about indices and the lower time frame stuff, but honestly I've been trying to again keep up with the chat family. It's so tough right now to kind of be looking at everything in the chat box. I'm trying my best, but it's impossible. There's only one major question that keeps coming through, and I feel like this is the question that so many of you have continuously asked me left, right, and center. Every single day I get messages on Instagram about this as well, even though I have posted a video, even though I've tried to make it as easy as I possibly can, and that's about our mentorship and courses and all of these things and what we do. Family, I have made this as easy as I possibly can for everyone. All you've got to do is you literally have just got to go to my website, which is pipsofpersia.com, right over there. Go to my website, pipsofpersia.com. On the website over here, don't judge, I've designed it myself just to make it easier for you guys, okay? On the website over here, you can go ahead and click on courses and mentorship and see exactly what it is that we do, get access to, get full information about exactly what it is that we do. And if you want to go ahead and get started, you can go ahead and click on partner up with us and literally just follow the information to get started. So everything is available to you on pipsofpersia.com. Now.
All righty. That's pretty much the end of the video. Vishal gets on there and talks a little bit about indices, but it's pretty much the same info, right? And I think that at this point, most people should kind of understand what we're saying when we look at the charts, what we're looking for. Is anybody confused when it comes to the market structure? Who's confused? I know some people are, but who are you? who is still confused? Who doesn't understand what to look for? Who is confused about the time frame? Do you know what style of trader you are? All of these questions should have answers. And if they do not have answers, then that's why you're not successful. So, at some point in your trading journey, you're going to understand why you are losing trades. Maybe you're rushing your setup. Maybe you're taking a trade that doesn't quite comply with all of your rules, because your rules are in place to keep you away from bad trade setups and to push you towards good trade setups. If this is your first time seeing the market structure series, I would suggest that you spend some time going back over the information. Normally, the second, third, fourth time, however many times you choose to watch it, you're going to get additional information. Plenty of times, I have went to the charts and kind of talked through trade setups or market moves. And I've talked either rally-based rally or, I might see some wicks and say, hey, man, there's an order block there. And then people will be confused as to why I know it's an order block there, or they don't understand the concept. And I think that he did a beautiful job of basically explaining why we say that there are order blocks, where we see wicks and all that other stuff, and why we trade order blocks, right? He described order blocks as rally-based rally or drop-based drop. It's the same thing, man. Like, just because he calls it drop-based drop and I call it order block doesn't mean that we're not on the same sheet of music. All of us are saying the exact same thing. And we all expect the market to come back and revisit these areas at some point in time. And this is why we sit and we wait for order blocks, and we sit and we wait for the market to tap into these order blocks. Because just like he explained in that video, when the market comes back to tap into your order block, on the lower time frame, the market just went through Wyckoff. It pushed away from that area, and now it's going to come back and validate that area. And that's when you take your trade. Now, when you're teaching somebody these concepts, it's too difficult to try to teach what he's saying or his level of teaching. It's easier when you teach masses just to say, okay, wait for the price to come to this order block, wait for it to tap in. I mean, it's very difficult to explain to you, hey, man, accumulation just happened, Wyckoff accumulation just happened. Now you got to wait for the market to come back and test the accumulation to go higher. Or Wyckoff distribution just happened. Now we got to wait for the market to come back and test the distribution or validate the distribution before we can take a trade. All of that stuff is true, but we don't say that every time that we're trying to teach or trying to communicate how to look for your trade setup. But all of it is very valid and it's very true. It just depends on what time frame you're looking at and you're looking for. I guess this is a great time to look at this on the monthly. All right. So if I look at this pair on the monthly chart, right? I want you to think about the video we just watched. So in the video, we discussed price coming somewhere, distributing here, pushing away, and it pushed away with some speed here, right? Even on the monthly chart, there is no tap in, right? But now you see the market came down, broke this low, right? This was a rally-based rally. The market pushes down, breaks through it, right? And now it looked like it's reversing. So those of us who trade, and you've been trading for a while, it doesn't matter what you call this, I can say, I'll put a fib right here. I'm measuring this impulse move, this drop, because I want to see a pullback to my golden zone, right? Or my 78.6. And then I want the market to push down. So if the market pulls back to my golden zone or to my 78.6, if it pulls back anywhere within this highlighted yellow area, this is the market pushing away from this area of distribution, coming back, validating your distribution and pushing away, even though it's a monthly chart. This happens on every time frame. This is what we mean when we say that the markets are fractal. He was just talking to you about something that happened on the 15-minute time frame. His instructions happened basically on that 15-minute time frame. He uses all the time frames. He even talked about a 5-second time frame. But all you're witnessing here is the same thing that he spoke about on a much higher time frame, right? Now, it doesn't mean that this reversal move has to go here immediately. I mean, this might not hit here until June or July, maybe even August. I've seen markets come back years later. Something this short, it might happen immediately. But my point is this: we know what we expect to see based on the setups of these charts, right? So if you were looking at this and you have two areas, let's look at it from the reverse logic here, right? You have a rally, you have a base, you have a rally. It goes right back into a base, a rally. So you have accumulation, push away from the accumulation, a reaccumulation. This market comes back and taps in, validates your area of accumulation, and pushes away with great speed. Now the market comes back and the first area it's going to test is this accumulation. It doesn't hold up. The market pushes right through here. Now it rejects right at the bottom. It rejects. Then it pushes further down back into this area of accumulation, right? So this area of accumulation, oh man, it's being tested twice, basically. Well, my mouse is not functioning, but all right, so this area of accumulation got tested. Now it got retested. And so far it's held up twice. So the range of your market is in between these two levels until it breaks one of those, right? This is what we call framing the market. This is a higher time frame. So your trades are going to take place in between these two levels. If you're I guess at the beginning stages of your journey, if you frame your market on these higher time frames, then when you get down to the level that you want to take your trades, if you're trading on the 4-hour, then all of this area in white will be available to you. And you can start picking the easier trade setups based on the amount of white area you have to allow your trade to run. So if you frame the market on the monthly and you go down to the weekly and the daily and so on and so forth, it's going to leave you, by the time you get down to the 4-hour, your frame might only be from here to here. And it might be a 30 pip move. Well, I don't want to trade 30 pips. I'd rather trade 100 pip move if I have a frame available for 100 pips. And then I would choose that as my personal trade setup that I want to take. So based on my trading style and my trading rules, I like to trade 100 pip moves. So your trading style and your trading rules might be a little bit different. But if you take the time and you do this every time, and I don't do this anymore because I'm past that, but if you'll take the time and you'll frame your market if you're beginning and you get it down to whatever time frame that you want to trade, this will, in my opinion, it will help you to advance in your journey, because you're taking it step by step and you're not skipping any steps. And you're not just jumping down here. Okay, let me see if I see Wyckoff in here. I know this is Wyckoff. Yeah, but in my opinion, this is not the best way to look for your Wyckoff, right? The best way, if you're beginning, is to look at the higher time frames, frame it up, keep dropping down, and then you'll understand the area that you want to see your trade play out in. You guys have any questions? Right.
Hey, Todd.
Yes, sir.
I got one simple question. On that monthly time frame, this is just out of curiosity. This last green candle, that's the February candle, right? So it's not complete.
Correct.
Okay, let's just say it was. Let's say at the end of February, it looks like this.
Mhm,
Based on the moving averages,
mhm.
is that something that we would believe will go up soon, or like it'll take a while because of those moving averages?
Well, so all your moving averages is going to be turbulence, right? If the market needs to come back up here, it's going to come back up here. Now, it might not be a clean sweep, right? It might be, it pushes in, it falls back, it pushes up, it falls back, but it'll eventually get through here. If you look at this, I mean, it came down through the moving average, right?
Mm,
So this candle, I guess in November, it pushed through the moving averages to the downside. So the market goes to where it needs to go, and it doesn't base its movements off the moving average. But what we do when we take these trades, as a trader, you have to be cognizant of these moving averages. So whenever you got this doji last month, right, the signal indecision, and you see the order block, you know the market needs to push up. But you would be a fool if you think it's just going to push right through the moving average. It went to the moving average, it rejected already. Already this month it went up and it pulled back. You see?
yeah, I see it.
So your first move as a trader is to make sure you take your profit once it goes up there. Then when it comes back, you can either sell it back or you can buy it up. If you drop down to the lower time frames, that move is probably pretty significant, as far as a pip count. So I'd have the market. So you just have to kind of understand what you're trying to see or what the market is trying to achieve. What I would suspect is you probably have to have an order block here before it would just push up. Does that make sense?
Yes, sir.
So there's two reasons, and I don't really base that off of this moving average, but what I'm basing it off of is basically the structure, right?
Yeah, the overall structure.
Right.
And the overall structure outweighs moving averages.
Yes. Your moving average just lets you know what side of the trend that you're on. Trends are broken all the time, but as a trader, you can't ignore the trend while you're trading. Does that make sense?
Yeah.
All right. So if I drop down to the weekly, we can see where the market pushed up and got rejected right here at the moving average. But it's not the moving average that rejects this, right? I mean, there is structure here. There's basically drop. This is a base that he just talked about, right? So whether you want to call this area an order block, it is on some time frame. This is an order block. That's why we got rejection. There's an order block right here. The price rejected at the order block. That's what made this reject. It doesn't mean that it won't fall down, maybe double bottom here and push higher. But if you would do your market framing, you're going to see this order block first, then you're going to see another order block. So you have two back-to-back order blocks. So this is not a clean trade that's going to put you through this area. Does that make sense? There's another order block right on top of here. So there's three order blocks that this price would have to push through in order to get back up to the area that it needs to take care of.
And there's another one to the left it tapped into.
Exactly. So that's why this trade back to the top side is what I would like to call a dirty trade, or it's not going to be a clean run. It's not an easy move. Let's drop down to the daily, and you can see all the turbulence right here, right? But if you look at this on the daily, your trend has changed, right? You went from a downtrend to now you have a swing low down here, right? The market was making lower lows until it made this higher low. then it pushed up. Now it's a higher low, and you can see the rejections that are happening when it tries to push down. So this market is pushing back up, looks like, to go to the area that we needed to tap into to sell down further. Does that make sense? I want to say that it was, I don't know, usually the middle of December. Do you remember looking at this, Leandro? Maybe we looked at it on the 2-month. Yeah. So I think in the middle of December, me and Leandra, and maybe even Selena, I don't remember, but I think we looked at these and we saw the 2-month OB, right? And we knew that price needs to come back up here, tap into this OB and push down. Now, these are super high time frames, but it doesn't matter, you know, even though the time frames are super high, it just gives you, I guess, a long range view of what you can expect as a trader. So we knew that going into January and February, right, that we wanted to see the market push up, you know, into this order block, right? Now, maybe it takes until June, like I said, to get all the way up here and tap in. We can't control the time frame. We just understand what we want to see when we look at these charts on this higher level. So this is why I had a bias, coming into these weeks or whatever, right? This is why I would look for areas that maybe the market would turn around and start pushing in the opposite direction. And we got some of these moves, this month. Do we have any questions over anything we covered? Okay, so I guess this is a good week for us to have these structured conversations, because we don't have a lot to work with going into the week. If you guys don't have any questions, I'm going to end this recording and we can get right into the market analysis.